Hello again. Once again, this is Jason Trafford from Total Business Solutions, Tax and Accounting Services in Phoenix, Arizona. And this is the second video in a four-part series helping people better understand their deductions. This, of course, if you've seen the first two parts, you, you would have known that exactly what my mission is with this whole process. I don't want to keep explaining it over and over again because these videos kind of get lengthy and boring because it's taxes. So I do encourage you to watch the other two videos that I had put together, and you'll get the full explanation. So briefly, this is for self-employed individuals. So if you're not self-employed, then this won't help you at all. So just saved you a lot of time. Okay, this next video is what I want to talk about is one of my favorite things is meals and entertainment. The meals and entertainment deduction is pretty simple. It is what it is, and the only thing that you have to worry about really is the limitations and what's required of you in recording this. First, let's go over the limitations. There are two different ways to record meals and entertainment or to deduct meals and entertainment. The most common is the 50% deduction. What the 50% deduction is basically every receipt that you save that is a receipt for a meal or entertainment that is for business and fits all of the rules for qualifying as a business deduction is reduced by 50%. The reason why the IRS does that is they see somehow in that meal you did receive some type of personal benefit from it, so you will reduce half that for your personal benefit and use the other half as your business benefit. So 50%. So the way this works is that while we're talking about receipts, the receipt needs to answer 5 questions, and it's the journalist type questions: who, what, where, when, and how much. So the receipt actually answers about 3 of those questions. They actually answers 3 of those questions. So the 3 questions that it answers is where it was, when it was, and how much it was. The who and what are the only things on the receipt that you would have to answer yourself. So say you met with me, your accountant, out for dinner, and you picked up the tab, taking your accountant out for dinner, as I hope all my clients do, and you would write down simply Jason, accounting. That answers your who it was and what was discussed. So now you're covered. You have that receipt, you file that receipt, and you claim that deduction. And as I said, if the meal was $100 because you took me out for lobster and steak, and then you receive a $50 deduction for it. Now, you give your accountant the entire receipt. The software that all of us accountants use take out 50% for that type of deduction. Now, what qualifies as a 50% deduction are meals and entertainment that you expect to discuss before, during, or after the meal or the specific entertainment. So if you expect to discuss business before, during, or after the meal, then it's a deductible meal. It's really about intentions. Are you going out for business? Now, if you're going out for fun and you're just hanging out with maybe you and your spouse are taking out a couple that you're friends with, and while you're there they ask you a tax question because you're an accountant, it wasn't expected to discuss it and it just came about, so it's not really deductible. What happens is that it's got to be basically pre-thought out and premeditated. So what happens is they invite you and say, hey, let's discuss this further over a dinner, and you go out and have that dinner and you discuss it further. And while you're there, if you happen to discuss some personal stuff while you're there, that doesn't matter. Your total intention was to discuss business, and the IRS does not expect you to discuss business with every breath of that entire engagement. So it is really what your intentions were to get there to begin with. So anyhow, the atmosphere also has to be conducive to discussing business. So this really goes along with entertainment. If you go to a rock concert where it's 180 decibels, it's not really conducive to discussing business. So But there's piggyback rule. If you go to a rock concert because you're entertaining a client, take them out to dinner to discuss business, well, the entertainment expense is really a piggyback onto that meal and becomes deductible. Even though it's a rock concert not conducive to discussing business, you took them out to dinner before or after the rock concert to an atmosphere conducive to discussing business, then it's all deductible because you were doing this for a client in order to enhance your business. It's 50% because you received a little bit of a benefit from it, your personal benefit, but then the business also received a benefit from your efforts and your money, so you get to deduct that on the 50% rate. So also the business discussed has to be basically the value. The values kind of have to match. For instance, if you take somebody out for a $75 lobster and you're discussing the trading of a $2 baseball card, the IRS frowns upon over or excessively using this advantage. So make sure that the business discussed is the value of the meal. It doesn't have to be the exact same value. In the example of that $2 baseball card trading, if you guys go to McDonald's and spend $12, $15, it's fine. It's just don't go too excessive. The business has to be worth the value of the entertainment or meal that you're discussing and that you're deducting. So keep that in mind. It's kind of petty and it's nitpicky, but that's exactly how it works. So that's pretty much the 50% deduction. This is the most common deduction. It's used all over. One little thing I'd like to leave you with before we move on to the 100% deduction, which is 100% deduction is very simple. But one last thing with the 50% deduction is that it is often thought, kind of just traditionally, that if a husband and wife goes out to dinner, maybe they can't deduct that meal, and maybe they can't, but maybe they can. The option is there. So if my wife, who works in my office a lot, if we need to, if we go to lunch and discuss it, because we just need to get out of the office to discuss the current business at hand, and we're discussing on how things are going to function and how I need her help around the office, and I go to lunch, that can be considered a meals and entertainment deduction. So it doesn't have to be this arm's length transaction. It could be, especially in a family-owned business, it happens a lot. So it could be a deductible meal. So keep that in mind. Next is the 100% deduction. The 100% deduction is basically any meal you buy to sustain the productivity of your business is 100% deductible. So, for instance, during tax season, I will have people in here working late and a lot of hours around the clock trying to keep things wrapped up, stay on pace with the deadline. And a lot of times I will order pizza or Chinese takeout or something like that and have them bring it into the office so that the employees can eat here and not have to worry about going out in town and trying to catch a meal real quick and then come back and get to what they're working on. So what happens is they get to eat in the office. It sustains the productivity. Therefore, the meal becomes 100% deductible as opposed to the 50%. So as you can see, like I promised, that was pretty simple. So if there are any questions about the meals and entertainment deduction, you can email me at jason@totalbusinesssolutions.llc.com. Again, that's jason@totalbusinesssolutions.llc.com. My website is www.totalbusinesssolutions.llc.com. And I look forward to the next part of this series. Have a great day.